Alright, welcome back everyone to week 5. We're going to be going over my strategy and how I actually trade, which is exciting. It's going to be a little complicated. I'm going to do my best to explain it. How I trade, so what I do, if you want to look it up on your own, if you look up ICT or Inner Circle Trader, it's his concepts, SMC, Smart Money Concepts. Smart Money is just Wall Street, trading with Wall Street, finding their mindset, what way they're trying to send the market. I use higher time frames to get a bias on the day, which direction I want to see us head, and then play on the 5 minute and try and find an entry in that direction. So we'll get right into it. There's two concepts I'm going to need to go over first. They're the two concepts that I use to enter my trades. Oh, I should also preface, I'm going to make this into 2 videos. This is going to be just going over my concepts and how to use them, and then looking at 1 or 2 trades that I took last week. And then next week, we had 2 great setups this week. Pretty easy trades, easier than some of them you gotta really keep an eye out and I don't know how to explain it, but I'll show you what I mean in a second here. But the 2 concepts we got to go over, so it's fair value gaps and liquidity sweeps, or just liquidity in general. So fair value gaps, they're going to be, so it's going to form within 3 candles. I'll draw it out here. So if you're looking at these 3 candles right here, I don't know why it's all curved. Well, let me highlight. Maybe this will work. No, I don't know why it's drawn like that. But God, this is bad. Hold on, I apologize. So if we're looking at these 3 candles here, so this little one, this bigger white one, then this gray one. So I look fair value gap. So that's going to be when there's a gap between the first and third candle in the middle of the second one. So I know that might be a little confusing, but if you look, right, so the top of this first candle is right here, and the bottom of this third candle is right here. So this area in between the solid candle, that's a fair value gap. So if you look in these 3 candles, this one, this one, this one, you'll see this middle candle doesn't have a gap in the middle where this first candle and this third candle don't come together. However, right here again, on this candle and this candle and this candle, from the bottom of this wick to the bottom of that third candle's wick, that's another fair value gap. And how I use fair value gaps is a lot of times when price comes back into this area, it will reject off. So if you draw this across, look, we came down, formed a fair value gap, price pushed back up, we wicked into it and had a big rejection down. That's how I use fair value gaps. The second concept is liquidity. Finding so what liquidity is Wall Street, right, or the big market movers. They have to buy a lot of contracts to move the market, right? You can't just buy 5 contracts; they buy thousands in order to push the market in a certain direction. But there's not going to be always a 1,000 shares available. So what they'll do is, you can look right here at this level. This is going to be a level of liquidity, right? So if they're trying to push the market down, what they're first going to do, right, there's not going to be enough shares available here. So what they'll do is they'll buy a bunch of shares, push the market up, and then people who are in trades, wanting to see it go down, who had their stop loss here, they get stopped out. So that means there's a lot more shares in the market now, and they're able to sell off and get a big push down. So they'll move up to go down. So how I like to find good levels of liquidity when I'm trading. First, I have an indicator over here for sessions. So what we're going to be looking at here is this orangish color and this green color, right? So this is Asia session, and this green is going to be London session. And when it starts this red, that's going to be New York. So we're not going to look at that for now, but just Asia and London. I like to mark out the highs and lows from those, from when those markets were trading. So they'd be right here. And then a lot of times you'll see as we come into US, we'll sweep one of those levels of liquidity. See, we push down and then push back up. We'll see that a lot of times. So here's another good example. I mark out the highs and lows. And before, so London closed here, US opened. Before we had to push down, what did we do? We pushed above liquidity, swept it, pushed down. This is a perfect example. We pushed down below this other layer of liquidity and then pushed back up. Eventually we came back down. But I like to see a sweep of liquidity. That's one of my signs I'm going to be entering a trade. And fair value gaps, but we'll go over that in just a second. So let's get into actually how I use this stuff. Alright, so I'm going to go on replay mode and go back to Thursday. Thursday I had a nice trade. We'll go to 9:25, right? Right before market opens. I mean, with futures, because this is for futures only. I'm trading NQ, or NASDAQ 100 NQ. So when you're trading futures, you can actually trade 24/7. You can trade the Asian hours or London. There's not as much volume, so that's why most people don't. And the only days the markets are closed are the weekends. But other than that, it's open all the time. So looking at Thursday, right? So, yeah, 9. Usually I get on the charts at around 9 o'clock and start looking up and try and find my daily bias. So first, I'll go to the 1 hour time frame, right? And I'll see what we're working with. So we can see the trend within the last couple of days has been a bit of a downtrend, right? So initially I'm going to be thinking we want to see something down. We'll map out some liquidity levels. So there's a big one up here, this high. That's going to be a high level liquidity. I don't think we'd get that push all the way up there within one day, and we're in a big downtrend. There's going to be a level of liquidity here. We'll mark that out for now. And then right here, we have a nice fair value gap right in here. We'll draw that out. So if you see what I mean, this bottom candle wick's right here. The third candle wick is right here. So in between here, it's a nice fair value gap. So initially what we're seeing, so we formed this fair value gap. We came down. What I'd like to see is a push above this liquidity level into this fair value gap for a play going downward. That's my initial bias and the trade I'd be looking for on today. So then we'll go down to the 5-minute time frame, and so first I put on this indicator that I have, the sessions indicator. Just it helps me mark out liquidity levels. So I'll mark the London and Asian highs and lows. So the lows for these two time frames right here. The high is right up here. So you can already see here, we swept the London liquidity high, and then that bigger, it's hard to see because it's inside of it, but we swept that other liquidity I had from the hourly time frame, right? And we're holding this fair value gap. So already before market even opens, I'm looking for something down, right? So now it's just a matter of finding my entry, because everything is you can turn the sessions off. I should also mention, you can, if you're having trouble finding fair value gaps, there's this indicator. It's called LuxAlgo Fair Value Gaps. You can look it up. I think you just type in fair value. It's like the first one. They can help you identify them. See, here's a fair value gap. Came into a push higher. So if you want to turn that on to help you find them, that's a good tool. But yeah, so we broke the layers of liquidity we formed. We're in this hourly fair value gap, so ideally I want to see something going down. So we'll start it. So market's going to open here. We get a big initial push down. I believe actually when I took this trade, yes, my bad. Thursday, we also had this fair value gap here, and I marked this one out. I believe it was this one. No, it wasn't. I'm sorry. It was this fair value gap up top here. I took shorts right at market open because I like the way we were coming up into this, holding this fair value gap, and I took shorts. I'll draw it out for you. I took shorts right as we worked into this fair value gap. As we already came into this fair gap, we came into this hourly fair value gap right before market opened. Then we came back up into this smaller fair value gap, and I took shorts right here. Put my stop loss. I put my stop loss right above the first fair value gap candle, so that would be this candle right up here. And then I draw out my take profit at the opposing liquidity level, so that would be down here. And then you can see as we continue, we got a big push down, kept going, eventually hit take profit. That was my trade on Thursday. Yeah, we marked out, I believe it was that fair value gap. Yeah, because I had this fair value gap marked out, but again, that was a bullish fair value gap, and I was looking, on the higher time frames for a play going down, and that's exactly what we saw. All right, we'll look up one more good setup here. This was Friday, so first start on the hourly time frame. What we were looking for, we had big liquidity level there, and then we had this fair value gap up top here, a bearish fair value gap. So again, what am I looking for? I'm looking for shorts again on today, because we have a bearish fair value gap and liquidity above. I mean, there's liquidity, there's a level down here, so this might be a target I'm looking for, but we don't have any bullish fair value gaps, so that's why I wouldn't be looking for any longs at this current moment. We'll go into the 5-minute here, turn on my sessions, then mark out again London and Asian highs and lows. So lows right there, highs right here. So already confirming my sentiment that I want to see a play to the downside, a bearish play. We already swept this London high. We swept that liquidity, so we're above it, so we want to see something down. We're in this fair value gap, the hourly. We swept this other big 1 hourly liquidity level, so I'm wanting to see something down. Now it's just a matter of finding an entry. So heading into market open, there's nothing in particular I'm looking at. And we have bullish fair value gaps here. There's a whole nother concept I'll maybe go over in the next video about inverted fair value gaps. We'll go over that in the next video, I think. For now, I believe, if I remember correctly, I didn't use this inverse fair value gap. Let's see. We formed a fair value gap right here. Yeah, and that was my entry right there. When we came back up into that fair value gap, put my stop right inside. When we came inside there, I put my entry. I put my stop above the candle before the fair value gap's high, so right up there. And then my target, I was targeting the opposing liquidity for Asia and London session. Initially, I was targeting right here, I believe, this first level liquidity, but then I saw, as you can see, in a minute here, almost got stopped out right there. See, that's why I put it above that first candle wick. Almost got stopped out there, but then we kept going down. Initially, yeah, I had my take profit here, but I saw this, huge sell-off, so I actually took some profit here, but then moved the rest down to this farther level liquidity. So I sold some here to lock in profit, and right there. Then after I get a big push, I kind of just eyeball it, but I take my stop loss and I move it to break even. So then if we do revert back up, then I wouldn't be losing any money. I would just be out at break even. But see, we have continue down and then push and get that take profit, and we had an even bigger sell off. It just kept going down for a while. But I'm not trying to catch the hugest moves. I'm trying to catch predictable areas where price is going to go. So if you guys watched my first video about going over my supply and demand strategy, you'll see like the differences. Now I have like set stop losses and set take profits. So like I know where I'm trying to like see price go. But here when I was trading this, it's like, we came up into the zone. It's like I could target down here, but quite a few times we didn't get there. So that's why I kind of switched. I find this strategy to be a lot more consistent, be able to see exactly where I want price to go, and have a better plan. And this way, when I set my stop loss and I set my take profit, and then I pretty much just sit back and just wait. And when price starts on my old strategy, when price started going up, sometimes I'd be tempted to, stay in when I should be getting out. But now it's like I set my rules, I stick to my rules, and just wait and see what happens. Also on Friday, I wasn't trading at this point. I don't trade usually later into the day. But if I was, this would have been a nice play. As we kind of bottomed out here and we started to see a pushback up. We had a break of structure. That's an ICT concept. I might go over it. You can look up videos if you want. But here we started coming back up, and we broke all these layers of liquidity. So I was watching this from my phone, but I wasn't going to trade it. But we had a nice fair value gap right here. This would have been a spot where I would take longs. We broke this liquidity up there, and we had this nice fair value gap. And what we do? We push down into it. If I was trading this, which I wasn't, but you could, I would have entered right when we entered, like inside of there. Would have put the stop at the bottom of that candle for the fair value gap, and then take profit. Probably I would have put at this liquidity level up here, and as you can see, we continued upwards and made it back there. That was a pretty big move on Friday, big sell-off, and then came right back up to where we started. But yeah, I think that's going to wrap it up for part one. Part two will be a little more complicated, but if you guys want, you can just go on TradingView and just like see if you can find your own trades using, or find fair value gaps, find layers of liquidity. Like right here, for example, we're trading below, but we didn't just push down. What do? We broke above it to then push down. That's how you find some layers of liquidity. You can find some fair value gaps. Look on the higher time frames, because the higher time frames is kind of where I get my idea of what I want to see with the market before going in and actually taking the trades. It's important to have a sense of direction where you want to go instead of just going in there and taking whatever you want. Because if I was just taking whatever, if on Friday, if I didn't have the higher time frame confirmation that we were bearish going down, I would have seen this huge fair value gap and been like, oh, let's come back into this and push higher. But we were, if you look, we're in the last couple of days on a bit of a downtrend. We had liquidity levels and fair value gaps, and that's basically what I was looking for. So yeah, that's going to be, the basic strategy right there. We'll get into some more complicated stuff next week. I hope I described and hope you understand what I'm saying. If you want, you can just YouTube. There's one guy that's really good, Casper SMC. This is a good guy I would watch. He trades very similar to I do. He made a whole hour and 20-minute video on ICT concepts, the whole course. It's a lot more complex than what I was describing, but he also goes over fair value gaps and liquidity and all that if you want to watch. And he's got other videos going over different strategies and whatnot. But yeah, try it out. Paper trade. Don't use any real money at the start. I wouldn't recommend it. You'll probably lose money. I did. Um, but anyway, best of luck. Next week I'll be going over this more, showing you more examples and covering more stuff. Hopefully next week. So as I was sitting here editing this video, I just wanted to preface, this stuff takes time, right? I've been, in the market now for, not even a long time. Like most excellent good traders have been trading for 2+ years. I've only been in the market for 9 or 10 months now at this point. So I got a bit of experience, a bit of time, but this stuff takes time. It's a little overwhelming at the start. You just gotta, it's one of those things, right? People think trading's like a get rich quick. It's not. It takes time. You gotta be disciplined. You gotta stick to rules, and you gotta control your emotions. That's the biggest thing. But don't get overwhelmed. Don't get upset at the start. It's a grind. It takes a lot of time and energy, but if you put the dedication, devotion towards it, in the end it'll pay off. But I just wanted to put that out there as I was putting these clips together. It's a little complicated. Trading's not easy by any means at all. You can go to college for 4 years, work a job. Honestly, that would probably be easier, but I didn't want that life. I want the free time that trading offers. Your money's uncapped. When you're at a job, you have a salary. With trading, it's dependent on how much you're putting in, how much you're making. It's all on you. That's why I decided to pursue trading. But if it's not for you, it's not for you. It's stressful. It's very stressful. I'm stressed out most days, honestly. But if you stick with it, it'll pay off in the end. But take your time. Don't rush it. It's not a fast process. It takes time, and a lot of people, they spend years doing this in order to get to see results. So be patient. Take your time, and you'll be thankful later.